Welcome everybody to a very special edition of the Not Your Average Investor Show. For those of you in the Fortune Builders community that have not met Greg and I, we do this show every single week. It's called the Not Your Average Investor Show. We do it live on Tuesdays, and we have a guest of honor that continues to show up for special editions. We call him a Hall of Famer. That's why we awarded him with a Not Your Average Guest Hall of Fame Golden Blazer, Mr. Paul Shively. Say hello, Mr. Shively.
If you see a huge smile on my face all webinar, it's because I don't like to wear suits, but I'll wear this one. This is going out in the next date night with my wife. She's gonna be like, "What in the heck is that?" And I'm gonna be like, "Don't you dare blaspheme."
Listen, that's a great idea, but don't limit it just to date night.
Yeah.
I
think this is a regular thing for you.
This is gonna be like, they saw a picture of Tiger Woods taking his Masters jacket out to like Chick-fil-A or whatever it is. You're gonna see me. I'm gonna post something on Starbucks or whatever. My next coffee in this thing. So, how to make a lady feel special. I appreciate it.
You are special. I'm your host, Pablo Gonzalez, and with me, as always, is the co-founder of a company here in Jacksonville called JWB Real Estate Capital. It's only manages about $1 billion plus of investments, has 20 blocks of downtown Jacksonville, 6,000 single family properties that they manage here around Jacksonville, sold to over 1,800 investors. Been on the front page of the Wall Street Journal a couple of times. I affectionately like to call him GC because he's got genius concepts, knows how to generate cash flow. He's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
It is great to be with you all today. We want to welcome the Fortune Builders community. We want to welcome our community. We've got a member from our community checking in. We like to call him the mystery man.
That's none other than Denny Davies there.
Denny Davies checking in from Kuwait. Ooh. Okay, ducking and covering over here. All right, man.
Wow.
I appreciate you taking time to do this, Denny. Thank you for your service, my friend.
Absolutely, Denny. We're thinking of you.
And also in the chat, we have our community manager, Joanna, who is ready to answer any questions you might have. Welcome you on to our community if you ever want to show up. Joanna, if you want to give them the link to the Not Your Average Investor Show, put that in the chat so everybody can see. And we're going to go through what is happening today, right? Like, as we all know, we've kind of had this bated breath of interest rates being really, really high for seems like, too long. And now they're starting to come down, which creates specific opportunities for real estate investors. Paul Shively, when you think of interest rates going down, where does your head go as the real estate investor expert extraordinaire Hall of Famer that you are?
I mean, frankly, just on a personal level, it's so nice to have a little wind at your back, finally. I feel like we've been swimming upstream for a long time, right? And I'm sure many of you feel the same way as well, too, right? It's just nice to have a little tone shift. It feels a little lighter. Things feel like, I got some runway. But it's interesting because I think we're in a bit of a Goldilocks zone, which I think we'll talk about a little bit today. Like, there's a little Goldilocks zone that my head immediately goes to, right? It's like those who have information and data and are facts-driven and data-driven are going to be able to act quickly and act well and set themselves up. And those who are kind of waiting for some of those lagging indicators and just, I'll wait for a couple more cuts. I'll wait for this. You may not reap as many rewards as there are possible to be reaped, right? Which is part of the reason why I love doing these shows.
Man in golden jacket says there's a Goldilocks zone. What do you think that's about, GC?
Well, I'm going to just piggyback off of what he said as far as those who understand and are educated and are surrounded by other successful investors will navigate this and produce great wealth. And then there will be others that largely listen to what their friend or their neighbor or the media says, and they might not. Right? We've certainly seen periods of time where that has happened. And you want to make sure that you're surrounded with a community like you are with Fortune Builders and with the Not Your Average Investor Show and us at JWB, because we can help you navigate this space. The reality is that the common public has no idea how to invest in an environment where interest rates have been high and then they've been signaled to come down. And that is one of the best opportunities to be an investor. If you think about it, over the last 40 years, We haven't had a moment where rates have been this high and then have signaled to come down. So most of us out there haven't been investing for 40 plus years. Some have and some haven't. So what you want to understand is, what is that relationship when you're in an environment where interest rates are this high and you have a lot of information to know that those interest rates are going to go down? What does that do for assets? And when interest rates go down, asset values go up. Interest rates go down, asset values go up. The reason is because as the costs of borrowing and owning those assets go down, because interest rates have gone down, investors look at that and they say, yeah, I'd be willing to pay more for that. So that's the environment that we're in right now. That's some knowledge that plays out even beyond rental property investing there. But when you have the opportunity to buy assets, specifically single family rental properties, where you know interest rates are going down, that's an opportunity to get an outsized additional return on your investment. And that's what we're here now discussing and super excited about.
Yeah, and we talk a lot on the show, the Not Your Average Invest show, about the 5 profit centers of rental property investment, right? We've got cash flow, we've got home price appreciation, which is what we're going to talk about right now. We've got tax savings, we got inflation hedging, and we got debt pay down, right? And we know that whenever we look at investors' portfolios, home price appreciation makes up, when you put it all on a pie chart, it makes up the biggest piece of the pie. And it makes up so much of the pie, 60 to 80%, that we call it the Pac-Man, right? It ends up looking like a Pac-Man. Everything else is the mouth of a Pac-Man, right? So that's why sharp investors pay attention to this idea of moments where we know that home price appreciation is going to blip upwards, right? Because I like to call it buying the dip, except normally you're thinking you buy the dip in other asset classes because it's at a discount. Right now, what we're buying is discounted borrowed capital,
right?
That makes the asset itself be worth more, right? Paul, you're in a bunch of different asset classes. Is this something that is, for every asset class? Does it affect one more than other? Like, how do you think about it?
Yeah, it affects all asset classes, right? So we do a lot of commercial real estate. We do a ton of single family real estate as well too. Yeah. I think it greatly affects the single family side even more than the commercial side, simply from a transaction volume side. So the commercial real estate side of the coin has really kind of been locked up just because there hasn't been the transaction volume that has needed to happen to really change the markets and move pricing. And so they just react slower, right? On the single family side of the coin, there's just more transaction volume, just the nature of the size of the transaction. There's more people buy houses. It just happens a lot quicker and a lot faster with a higher frequency, which is good because we can see the effects and impacts of some of these decisions that are made from the Fed on downhill quicker and faster, and they become more real, which is tremendous for all of us as investors as we build our portfolio. So I'm particularly excited for all the assets I do own, all the assets I'm going to acquire, right, on the single family side, because of this Goldilocks zone that I think we are in for sure.
Like it. GC, I think that you've got a slide over here that kind of explains this concept of the Goldilocks zone, right? And how this works with residential. You want me to share it?
Yeah, absolutely. Because you know what? We all like to kind of take these topics that are a little bit more in theory and just kind of make it real tangible and make it something that, quite frankly, that I can understand. And so when I started to think about this, what happens with interest rates going down and asset values going up, I started to think about it in terms of how people make decisions when they buy their home. Because like Paul was talking about in the commercial space, that's a different asset that will respond differently when it comes to interest rates than single family homes. And there's a lot of advantages for single family homes, right? For those who don't buy single family homes as an investment, right? Your neighbors in your neighborhood, Pablo,
yep.
How do people make decisions on buying a home that they love to live in and they make all these emotional decisions? How do they make their decision?
Yeah, I think about, I bought this home in January, right? And for me, it was thinking, what is the price of my monthly payment at renting versus buying a home? And like, how much house can I afford based on how much money I get paid or I expect to bring in every single month? And that being a certain percentage of my take home income, right?
Exactly. Home price affordability, monthly payments.
Yeah.
That's how people are making decisions on the home that they buy.
Mhm.
And if they can afford it, they're not looking at it as a return on investment. Now, we in this community are, but the majority of those who buy single family homes do not. They make decisions on monthly payments. So if we're in an environment where we know that interest rates are going down, think about it from this perspective. Over the last year, you've already had home prices that have gone up. And over the last year, you've had interest rates that have been higher. So think of that as like validation that people are buying properties at a certain monthly payment.
Mhm.
If you all of a sudden have interest rates go down, that lowers the monthly payment,
Mhm.
which creates more and more demand. Many of you are reading articles now about how mortgage applications are up all
Yep.
of a sudden as interest rates have started to go down.
Mhm.
And what that does is it increases prices, increases home price appreciation, and you probably can even get back to that same level of monthly payment you were at before interest rates started going down. So I started to put some numbers to it. And here's what you can kind of see on this slide. And by the way, guys, we do have all these slides available for you. If it's something that you'd like to see these slides, we've got, you can just text somebody on my team here. You've got Tiara on my team you can text, and her phone number is 904-293-0341. Did want to make sure we mentioned that. If you guys want any of these slides we're going to share, and it's real person, it's Tiara on my team.
Yeah,
So
I just put it in the chat for everybody to reference.
perfect. So we started to put the numbers to this. And if interest rates would drop to 5.75%, Jacksonville home prices can rise another 11% without increasing monthly payments. And guys, what we're starting to see is interest rates have dropped from above 7%. Now they're in the low 6s, and you're already seeing this start to happen. So what's going to happen is more and more people are going to apply for mortgages. More and more buyer demand is going to be created. And they're going to look at this and they're saying, listen, I can get in for maybe less or even the same monthly payment as what I could get a year ago. I'm in.
Yeah.
And so this is what's going to drive home prices up because interest rates have gone down.
Yeah, and you guys both bring an interesting point up, right? Like we here are thinking like investors, but the majority of people that buy single family homes are families, right? Are just people looking for a roof over their head, right? So that activity, I think the statistic is something like under 20% of single family homes are bought by investors, right? So it's like 80% of the market is really what's going to drive the activity. So if I'm sitting here looking at a home that I was like, man, that thing at 360 last year is my dream home, but I, can't afford this payment, but now it goes up a little bit more, but my payment actually went down. Now I'm thinking, okay, it's time to make that move, right? Like I assume that that's what you call the Goldilocks zone, Paul, is this idea of like the latent demand sitting on the side that's been eyeing something, that's been saying, yeah, it's a little bit out of my monthly reach. But the moment it goes up, they're like, boom, babe, let's get our papers in. Let's buy this house.
Exactly. Yeah, you nailed it. And apologies for taking off the jacket. It's so nice, and the thread count is so high that it was making me sweat a little bit. I apologize. I feel a little hot and bothered.
I don't want to make you uncomfortable with what I think about whenever you disrobe on camera. It's fine. It's fine with me.
The Hall of Fame jacket's still there. So, but for the Goldilocks zone, you hit the nail right on the head. Right. I think it's rare, and Greg, you mentioned it, which I love that. It's rare to find an opportunity, if you zoom out, where you are fairly certain to very, very certain of what's about to happen, right? When you zoom out, those moments in life are rare and should be taken advantage of, right? So what are we fairly certain is about to happen? All you guys just talked about, right? The Fed is cutting rates and will probably continue to cut rates. Whether they don't cut one next Fed meeting or not is not the end of the world. They're going to be going down. The Fed has signaled that. That is what the economy needs. It's going to be happening. At what pace and at what rate, frankly, is a little bit irrelevant. When you zoom out to a 10, 15, 20-year window. Rates are going to be going down. Okay. Exactly what you just said, Pablo, as well. There is pent-up demand, right? And we have had historical housing shortages really across the country for a long time. So inventory and supply, right? Supply and demand. Supply, and we can talk about this in a little bit, Greg, I'm sure, is, supply is relatively unchanged. And there's some more coming online with good. We need it. It's a good thing, right? And demand is about to spike for everything you just talked about. So we're in this zone where we can predict the future with pretty darn good accuracy, right? So it's this zone before 2 years from now where we look back and say, oh yeah, that was a big spike of price increase. I wonder why that happened. Well, we know why it's about to happen, right? So we're in this zone right now for probably the next 6 to maybe even a little bit less months of we haven't seen the big price increases, but we know the demand is coming. They're cutting interest rates. We can read the writing on the wall. We're in the zone right now. I call this Goldilocks zone before we start to see the real effects of the housing price increase that we know is coming, right?
Yeah, member of our community that's also a Fortune Builders member, who we also, our nickname for him is Hall of Fame first baseman Jim Kirko.
Yes, love that. Love that.
So you guys have a lot in common: baseball and Hall of Fameness, just different halls of fame. But Jim is asking, interesting point that 1% drop in interest rates translated to an 11% increase in price. Did I get that correct? That's not what you're saying, right? You're saying that a 1% drop means that the same home payment means it could go up 11%, and I would buy 11% more home, which is more likely that I'm willing to pay an 11% increase in price, right?
Yes. If you operate from this perspective, whatever monthly payment I paid before, I'm good with making that decision again. And when I say that, I mean the people who are moving to Jacksonville are good with making that decision.
Yeah.
This year, people made that decision 28,000 times. That's the number of home sales we have in Jacksonville at this same monthly payment. Well, now when interest rates go down, people should be willing to make that decision at that same monthly payment again. And as interest rates go down, home prices in effect could go up another 11%, and that monthly payment would stay the same. So that's the foundation of how home prices go up in an interest rate environment that is going down.
Got it. So right now my takeaways are interest rates are going down, asset prices tend to go up, right? Whether you're buying a business or you're buying a home, you can now get cheaper money so you can buy more for your money, and people love a good deal, right? The other thing that I'm hearing is when it comes to the single family asset class, there is a Goldilocks zone of, that 80% of the market that aren't real estate investors are just thinking about this emotionally. Like a family is looking for a home and they've been eyeing this thing and they've been waiting for the interest rate to drop so they can buy it at the same price but pay less. That has been pent-up demand on the sidelines that's coming in. It's going to permeate the market over the next, medium term. Prices are going to rise. So there's like a unique opportunity right now as an investor to lock that in for 30 years, this home price appreciation right up front, get in and know that you're already playing with a winning hand to start, right? So if I'm somebody that's on this call, I am someone on this call and I fit this bill, right? Like some people may have a couple shekels saved up that they're looking for a smart investment. Great time to be like, oh man, push your shekels into single family homes. Then there's other folks on this call that might be thinking, man, great, but I wasn't really planning for this, but I like what I'm hearing. What are my options here of like, how can I get creative in being able to like take advantage of this like Goldilocks zone? I would love for the two of you who have been through so many deals to just talk about kind of like creative ways to push in when you know that you've got a winning hand. Paul, is how do you like to advise people with that when it comes to the passive investment side?
You're probably going to get sick of this answer, Greg, but it's the same answer I always give every single investor, every single radio show, every single guest speaking job I get is, if you spend time figuring out your plan, the decision-making process is so much faster and so much easier, right? And if you've been on these shows, if you're regular, you've heard me say that before. If this is your first time on the show, welcome. We love having you here. I love doing these. Take note on this. It's 2 parts prep, 1 part execution, right? And so it's spending time on your 2 parts prep. Get on the horn with someone, text that number, get on the horn. Someone on Gregg's team will call you and walk you through your plan and walk you through. And step one is, well, where are you right now? Right? Which is, where is the capital that you have currently invested? What do you have in other real estate? A lot of things you can go to tap different capital sources, which we can get into in a minute, because I think that's where you want to go is as investors now in today's world, where can we find some untapped capital potentially, right? But then number two is you should really have your dominant buying objectives, your goals, why you're doing this. Pablo, we've talked about this previously with you, right? What are your goals? What are you doing? Your goals are very different than my goals, right? And that's good. And I love it. And neither is right nor wrong, but you need to know why you're buying, because it helps your decision-making process go quickly. More specifically in today's world, this may be an unpopular opinion, so don't throw tomatoes at the computer screen, right? But stock market's been on a run for a long time. And if you zoom out and look at the historical averages, stock market loses what, half of its value every 7 years, roughly, I think. Half its gains every 7 years, whatever the stat is. Might be a great time to take some chips off the table and reinvest into an asset class that has some stability and some upside coming up, right? And I know that's probably an unpopular opinion, but that's what I personally believe as well too, is I think the growth we've seen in some of the sectors that people are probably being invested in the past couple of years is going to be hard to sustain in the future world. Might be some great time to take some chips off the table and reallocate potentially, right? And Gregg, and we can get into some of the more traditional, because like, for example, I'm reallocating my own wife's retirement account right now, right? So that's one we can talk about. There's ways to credit partner. There's 1031 exchanges. We can talk into a lot of different ones. But I think one that's really applicable that a lot of people aren't talking about today, in today's world where we sit right now with an election coming up, we got some wars in the Middle East, we've got some dock workers strike, we've got some weird things happening in the world right now. You look at the bull market we've been on for a long time, there might be some time to reallocate some of those profits that you've made.
Yeah, I'll jump in there. I mean, there is a lot going on in this world. I feel like every day I find out something. Just over the last 2 days, we found out two things that I think are rocking the world, with increased activity in the Middle East and now the dock workers strike. I mean, so there's a whole lot of reason to run to an asset class that has proven to be consistent in times of stress.
Yeah.
And, it's interesting because for so long, the talking heads out there have been talking about how there was going to be a real estate crash, even before the pandemic, but definitely since the pandemic. And it's not a surprise. It's not a coincidence. We talk about this often on the Not Your Average Investor show about how it's not a surprise and not a coincidence that single family rental properties have performed so well and so consistently in times of our greatest stress, especially over the recent history. The reason is because it's a critical need. This asset is a critical need. It's an individual need for us as individuals to have a roof over our head. It's a critical need for the communities that we serve, because those communities are better when we have more and more homeowners, and it's a critical need for our country. And that's why our country and our government makes it so easy to get loans like we have and encourages first-time home buyers. So when you think about critical needs, what that does is it mitigates your risk. And that's one reason why so many are running, who are in the know, like you all are running to a consistent asset class like single family rental properties. But let's just talk about a couple of things that might be a great source of capital for all of you. You might not even be thinking about it, but this is a great time to be a little bit creative and find those sources of capital. How about the fact that many of us are homeowners out there? We might own investment properties as well. But what has happened to our equity numbers over the last 3 years, 4 years, even going over the last 10 years? What has happened to our equity values, Pablo?
As somebody that's been doing this for the last 4 years, I know that I have a surprisingly high amount of equity built into my homes right now. The 5 that I own, I know I have somewhere around like $250,000 of like equity that have just happened
Right.
Yeah.
You don't see that in your bank account
Yeah.
right now, but because you're a JWB client and you're in the know about what your investments are worth, you know that that is in your wealth portfolio. Well, that is very similar to you out there. If you live in a home, if you own a home, if you own multiple properties over the last 3 years, 5 years, 10 years, you are one of many who is sitting on trillions of dollars collectively as a country, maybe the greatest amount of wealth in terms of home equity that we have ever seen in our country. And all that equity is, it's a tool to help you create more passive income.
Mm-hmm.
Or you can do what most people do, is just let it sit there and do nothing with it. And your return on equity, if you do nothing with it, is zero. So let's be like those investors who understand how to use smart debt. And we can tap into the equity that we have in our homes to create more passive income. So there's probably a great opportunity for refinancing, especially if you've been owning for even more than 5 years, because your interest rates are probably pretty consistent with what they are today, somewhere around there. And at least they're consistent with what you can get if you're a JWB client, as we get preferred interest rates. So there might be an opportunity for you to cash out hundreds of thousands of dollars of equity that isn't serving you any other way, and to turn that into 2, 3, 5 single family rental properties. And that's available to most of us out there who are homeowners. Paul, you also mentioned a couple others that I think are really important.
Greg, real quick.
Yeah.
You talked there for a while, and I think the moral of the story is cash out refinancing. I don't know if you ever said that.
There you go. That's why we make such a great team.
Right. So the idea that, as this is something I'm actively looking at right now, right? Like the latest one that I have that has my highest interest rate, that has about 120K in equity. I'm looking at refinancing this home that I bought a couple of years ago, that I bought at, I think, like 225. Now it's worth like 350. I get a new loan on that thing. I take that extra 125 that's part of that loan. Well, I pay off my old loan,
right?
Take that extra 125 that I have and use that as a down payment in picking up another single family rental property, because I know that this is happening right now, right? So that's just the dynamics there for the layman like myself.
And so that is there, and many people are not aware of
Yeah.
it. But what you just talked about right there is replacing your current loan. You might be saying out there, well, yeah, I own homes. I own them. I bought them 3 years ago, but my interest rate was super low. It was 3% at that time. I don't want to go ahead and get a new loan and pull all that cash out, because my new interest rate might be closer to 5 or 6%. And we can run that analysis for you. But let's say that it doesn't make sense to do that. Well, there are loan products out there that allow you to keep your first loan in place.
Oh, really?
Yeah, and tap into that additional equity as well.
Okay.
So you can keep the existing loan that you have with a super low interest rate and still access that equity. There's also home equity lines of credit, which are available as well, mainly on primary residences. But these are all of these things that are available to you to tap into that equity so that you can use it to your advantage rather than just letting it sit there dormant. And I will add, do it in a conservative manner, right? Use debt as a tool, use it conservatively with resources like Fortune Builders, Paul, of course, JWB. We know how to do this in a way that you're not being overly aggressive and putting yourself at risk because of using too much debt.
Yeah, and that's a great point, Greg. And one thing I want to slow down on this point because it's so powerful, right? Debt is an accelerator if used the right way. It can accelerate your investing and wealth creation in a tremendous way, but it needs to be used responsibly. And Greg, previously on other shows, I've shared like our refinance calculator that helps people do all that math. It's exactly what your team, so if you're a Fortune Builder student, you have access to it. If you want access to it on this call, text that number. Pablo, if you can throw that number up again as well too, right? You can text that number, get on the phone to do the exact math. Because again, a more educated, more informed investor will make better decisions, right? So you text that number and you get on the horn with one of Greg's team, and what they're going to do is show you, and it's just math, right? Math doesn't lie. That's the beautiful part of this. Math doesn't lie. It can't, right? So Pablo, if we're able to access that $125,000, right, And even if your payments go up and your cash flow may go down on your current asset, right? So hold on, wait a minute. I'm trading a 3% for a 6%, just random example, just so it drives the point home, right? I'm not saying that's going to happen. Just wrap everyone's brain around this. Well, my cash flow will go down. I don't want to do that. Well, time out, right? That $125,000 that you have in that one house, Pablo, it's just sitting there, right? What's the return on it right now? What is it doing?
Zero.
It's just sitting there, right? Well, technically, if you look at it, what we should look at is take your cash flow you are getting now, not against your original basis that you put in, your 20, 30, 40, $50,000 down. You should take your cash flow you're getting now off your original basis plus your equity, because that's all your money in the deal right now. You have that money. That's your money. So it's your total return on equity, right? And we're changing what we're thinking about. Yeah, this is performing well because I originally invested 30 grand, 40 grand, 50 grand, whatever it was, right? And so I'm making X% return. Well, you've got this chunk of money too. When you add this chunk of money to it, let's look at your overall return. Ooh, it's not as good. Well, now all of a sudden it's like, well, hold on. I can unlock this 100,000, 50,000, 200,000, Pablo, reinvest it into something else. This $200 I may be getting may go down to 150 or 110, but I can free up another investment over here and my overall portfolio grows. Okay, all of a sudden, mathematically, this makes a lot of sense to swap out a 3% for a 6% loan. Do you see where I'm going? Right? If you think about it emotionally, I would never change a 3% loan for a 6% loan. The tools of the wealthy people don't think that way. Wealthy people will gladly trade a 3% loan for a 6% loan if it grows their overall wealth or helps increase their overall cash flow. Whatever their goal is, if it helps them get to their overall goal, that's why I said at the beginning, knowing your goals are really, really important. You let the math and the financial engineers like myself and Gregg's team, we're financial engineers. We create financial outcomes through these things. That's what we love, right? Let us show you how to do this in a creative way, like Gregg was saying, right?
Return on equity. I
Love
don't think we've used that term before. Every time Paul comes up here, he coins something new that I then like noodle on for the next 6 months.
I gotta earn the jacket, man.
Gotta earn that gold.
I gotta earn it.
It's so good because, and I love the reframing of it because, listen, as investors, we are here to use the resources that we have to produce the best return on that. And all of that equity is a resource for you. So if you look at what your return on equity is, it's like, how good of a manager of your money are you being, right? There's return on investment, which I think we all kind of talk about a lot, but return on equity is another step and just as important to see, are you using your resources to the best of your ability? And if you use your resources to the best of your ability, you know what happens? You get to your financial goal quicker. And that's what equity allows you to do.
That's that we talk about the tools of the wealthy or the secrets of the wealthy, or you talk, how did these wealthy families get so wealthy and it just continues to grow exponentially? How does that happen? They do stuff exactly like this, right? They take their equity and they don't let it sit. They constantly reinvest it, harvest it. And I think someone on the chat even said it. You buy it, you cash flow it, then you refinance and you strip it out and do it again. You do it again and do it again. I mean, that's what wealthy families in this country and across the world have been doing for decades. That's how you create generational wealth. Right?
Yeah.
Sure.
I love that.
I
Yeah.
feel like
I'm fired up now.
I am.
If that hasn't fired you up, man, I don't know what will.
Yeah. Return. Well, Paul, underneath that sign welcoming you is like me brainstorming a whole bunch of names on how to name this, what Denny called like houses having babies. So I think this return on equity thing is going to like, we figured out like the path to $1 million on that. I don't want to tease it too much, right? Because Gregg's been working really hard at it. I don't want to just vomit it all over people, but you got me noodling, man. You got me noodling on like the return on equity thing. I really like it because I hear so many people get so tripped up on cash return. And these other kind of like old school ways of looking at it that they don't want to look at that whole pie and look at that leverage piece. It reminds me a bit, Diane Jacques is asking in the Q&A, she had put here a while back. I was waiting for the right time to bring it up. What about the 1% rule for rentals? The monthly rate should be 1% of the purchase price, question mark. Will rents go up because price increase, or will rents go down more for people renting who are buying, therefore decreasing the number of people looking to rent? Paul, what do you think of that 1% rule when it comes to tools of the wealthy?
I apologize. I was reading Jim Kirko's question while you were reading that one. I'm sorry. Greg, why don't you
I can
take that one?
one.
Yeah.
Yeah.
Listen, I know we have heard about the 1% rule, but the 1% rule has caused just as much damage to investors as it has helped investors. Okay, so the 1% rule is the thought that the monthly rent that you buy in your asset, the monthly rent that you receive, should be 1% of the purchase price. And the benefits of this is that it helps produce positive cash flow. It's easy to understand, right? For $100,000 home, it would be $1,000 a month in rent. For a $200,000 home, it would be $2,000 a month in rent. So it's easy to understand, and it would make sure that you're getting positive cash flow mostly. But here's the problem with it. Especially newer investors cling to it. And they say, you know what? If it's not the 1% rule, well, then it's not a good investment. And I got to tell you guys, I don't know of a market right now where the neighborhoods you want to be in with a team supporting you, like you want a team to support you, I don't see the 1% rule anywhere. And really what it reinforces, and I think the reason that I get a little bit frustrated about the 1% rule is because the 1% rule is all about net rental income, which I love. Net rental income, cash flow, I get it. But you know what I love more? After owning over 300 rental properties myself and managing $1.3 billion of single family rental property assets, I know what successful rental property portfolios look like after you hold on to them for 5 years, after you hold on to them for 10 years, after you hold on to them for 20 years. And so you know what I love more? When I look at those portfolios, I look at how did they create that wealth? And net rental income has never been the number one contributor to that wealth. The other profit centers like home price appreciation, principal pay down, even tax savings, they dwarf net rental income. So the reason why I say it's done as much damage or even more damage for investors out there is if you focus and you just keep blinders on net rental income, you're going to miss the big picture. And with home prices going up as much as they have, rent certainly did not keep pace with that. You're going to find yourself in an environment, if you are subscribing to the 1% rule, you're going to find yourself in a market that is not poised for growth. And you're going to find yourself either doing all of the work yourself or working with the cheapest provider out there, and you're not going to have good incomes, or excuse me, not going to have good outcomes. So retrain our thoughts on this 1% rule. It is an old way of looking at it, and it made more sense 10 years ago, but it really can lead to poor decisions in the environment that we're in right now.
When I think of the 1% rule, it's a rule of thumb, right? Like, and those are these rules that people make when if you have imperfect information or you need to make quick decisions, these rules of thumbs play well. What I'm pumped about for Diane is that she's invested in fortune builders, right? Like you don't need to subscribe to a rule of thumb as much as like validate the things that are best for you based on this community that you've invested in, that you surround yourself with, right? So that we get that question all the time. And I think that you've gotten really good at answering it. And you get a little heated on it, but it's true, right? Like this idea of seeing home price appreciation over and over be the thing that we've continued to see members of our community make millions of dollars on while they're making thousands of dollars in cash flow, makes it pretty easy for me to like look beyond the 1% rule.
That's it. You get to look at the numbers. You get to see how money actually is made in this asset class. Wow. And you just get a little frustrated when you're only looking at one small point. And so it's about understanding all 5 of these profit centers, and that's really how you win in this game.
Yeah. So to recap the call, right? Interest rates have dropped, assets go up. Particularly in single family homes, it gives us the real answer to the test that is about to happen. And that gives us an opportunity, what Paul calls a Goldilocks zone, right? Like this moment before the rest of the market catches up to it, that investors can jump in on and bake in a little juice, right? A little extra wins, a little speed to win on there. So it begs the question of, okay, so if I'm in this, and then we've talked about these creative ways of getting in there, right? Paul, you talked about asset reallocation. Greg, you talked about refinancing, right? There's also ideas like 1031 exchanges. Like if you're like in a non-landlord friendly market, or you have this like one property that you're not crazy about its performance, or you don't like your property manager wherever you are, changing to, you know, a team that can do it for you, that is in one of these growth markets, has these opportunities in a tax advantage ways, is a real way to like tap into some capital and tap into this juice, right? So I think that the next question that I would have in my head as an investor, and the reason why we put together this presentation, is because in this moment, in this Goldilocks moment, there is this pent-up demand on the sideline. There is, as has been, undersupplied market of people that want to buy homes. So it's important to act fast. It's important to be able to like make a good decision intelligently in a expedited manner and know that you can trust it. So where do you find an asset so quickly that you can take advantage of this Goldilocks zone in a market that everybody is going to want and all that stuff? And Greg, you've put together a couple of slides here about exactly what JWB does, right? So I'm like the not real estate professional in this group here, right? Like I have my own other business, completely passive investor, and I've been investing with JWB now for 5 years because what they have built is a machine of 120 people that are dedicated in bringing these performing single family homes to market, having them ready for you because they happen to invent build to rent inside infill lots so you can predict inventory. And that means that they have currently functioning, cash flowing, home price appreciating, single family homes in the best neighborhoods in Jacksonville that appreciate the most, currently available. So we're going to walk you through this. But before I ask Greg to walk you through this, I just want to show you a little sneak peek at this whole presentation that we've been kind of referencing, and invite you again to text Tierra for this, because this is part of a big update that we do every single quarter together, where Greg looks at everything that's happening in the market, right? Like, what is everybody afraid of, right? This elections, shortage of supply, all these other like bad news things that we've seen over the years, these common fears, right? Of like real estate values dropping during election years, common fears around interest rates having declined sales volumes. There's a whole bunch of research in this presentation. So I just want to invite you all to text Tierra, get this thing. And while I scroll down for 40 slides of great information to get to what we're actually going to talk about here, just Greg, do you remember the number? Can you just say it out there?
The number, oh, for Tierra?
Oh, that's actually right here.
Oh,
904-293-0341. Joanna, our community manager, put it in the chat as well. But Greg, why don't you talk to me? What slide do you want me to get on here?
Let's go to the Jacksonville market slide.
Yeah.
Because, I remember when I was thinking about making my very first investment property, I was like, I feel like I have an idea of the data I should look at. But the more I would do the research, the more I would find one data source that had home price appreciation, and then another data source that maybe had rents, and then maybe another data source had population growth. And I lacked one common single source of truth. And it made it hard for me to understand where my market stood up against my other alternatives. And so, our team, we pay good money to be able to have the data from a single source of truth. It's a consultant that we hire and get this data reported, and it helps us help our clients compare apples to apples with other markets. And so I wanted to share some of those findings with you, and just what sets apart the Jacksonville real estate market. As marketers, which you are a marketer at heart.
More that than a real estate.
I might be a wannabe marketer. We love that word only. When you can say that your product or service or market is the only thing out there, it really means something. And as I started to go through this data and looked at all of the top metro areas out there, what I found is that Jacksonville is the only real estate market in the country that can say these four things: that prices are below the US median, that rent price growth is above the average for the US, that home price appreciation is above the average for the US, and that population growth is above 2% for the last 5 years. Guys, those are the 4 most critical stats that would lead you to a better return on investment over the long haul for your single family rental property portfolio.
This is low interest rates, rising prices, independent. This is just, everywhere has interest rates dropping. Single family homes are likely to rise. This is just an average, this is a unique insight into the Jacksonville market that Greg and his team have, which is, one of those reasons for maybe doing a 1031 into this market. Right?
Yes. Yes. And I do want to mention, again, Tiara is here to be a resource for you. Tiara is here to help you understand if you have questions about investing, if you want to set up a time to chat with our team. Tiara is here to help you, so you can send her a text there. If you have questions about where your market stacks up, we do have that information, and we're happy to prepare a kind of an apples to apples comparison with you. So you can reach out to Tiara. Now, that is a requirement of a lot of time for us to kind of put that into place. So just be prepared. It would be something we would get on the phone and share that information with you. It'd be a part of our normal conversations with you. It's not something we're able to just send out right off the bat.
Hey, Greg,
But
Jamila
this
is
is
saying
there.
that number message, that no voicemail is set up. That's just a text only number, right?
Yeah, that's a text only number.
Yeah. So Jamila, what you want to do is just text Tiara, and
Yeah.
then she'll get back to you, and you'll set up a call.
And
right?
if you'd like to call the office, it's 904-677-6777. And that's the direct line to the office. This is just individually Tiara's text number.
Yeah. Yeah. So if you really want to talk to somebody right now, Jamila, feel free to call. 100 people waiting.
There you go.
Yeah.
So really cool data here that gives me confidence beyond the fact that I've been investing in Jacksonville for 18 years to know that we really have something that is unique in the investing space. And that's really what Jacksonville kind of represents. So now that we know that, though, well, first of all, Paul, I wanted to ask you, man, did you know these stats about Jacksonville? You're an investor in Jacksonville.
I did not, right? Specifically that it was still lower than the median. That was surprising to me, right? Simply because the houses I bought a couple for my dad, bought a couple myself, but like the ones that has helped my dad retire have grown so much, right? Since the time I bought them. It just took me by surprise. That was a bit of a like, oh, I'm in this every day, and I still didn't realize that it was still, in the grand scheme of things, amazingly affordable, right?
Yeah. Still underpriced, still upside.
Which is surprising.
Wow.
It's really surprising. So in a good way.
I got to be honest with you. I live this, breathe this every single day. I know the advantages for Jacksonville. I know that we have significant advantages, but I didn't know that the data was this clear, that we are the only market with those things. So when I put this data together a few months ago, I was like, I'm going to start to share this with everyone. So now that we know that there's just clear advantages for the Jacksonville market, let's take it one step farther and show you what you have the ability to invest in passively with a vertically integrated team like JWB. So we sell single family rental properties, and think of it as us serving it up to you on a silver platter. We have an entire team of over 130 teammates here in Jacksonville in the JWB office. And our entire job is to make it easy for everyday investors to be able to take advantage of this asset class. And it doesn't require that you are a real estate expert, doesn't require that you live anywhere near the homes. We've built this entire product and service and offering to make sure that we can cater to everyday investors who are busy and who don't have to be real estate experts themselves. So this is one of the offerings that we have. This is a currently available JWB property. It's at 2113 Lewis Street. And I just wanted to show you this as a representation. It is available right now, but there are many other homes that are literally just like this one. And we tend to think of them as widgets, as tools to help you achieve that financial outcome that you want. But just some high level details. And again, I'd encourage you to get on the phone with our team, call or text, call the office or text Tiara there and get more information. But what you'll find is that our rates of return are somewhere around 10 to 11%. This asset happens to be an 11% rate of return estimated. Purchase price, $210,000. Pretty normal for us. Your purchase prices will be somewhere between about $180,000 and $280,000. So again, if you're in California, New York, Virginia, one of these high price markets, you have an opportunity not just to buy in Jacksonville, which is a low priced market, but we serve these workforce housing neighborhoods where your prices are even going to be below the average in Jacksonville. We focus on new construction. We do have renovated homes as well. This one happens to be new construction. And you can see this one is a 3-bed, 2-bath, about 1,100 square foot home. Very common to have 3 beds, 2 baths, or 4 beds, 2 baths, or some variation for that size of a home. Almost all of our homes are rented at the time of purchase. So as I was mentioning, that this is sort of served up to you on a silver platter. Imagine being able to get on the phone and after a few phone calls with JWB say, you know what, I'm going to go ahead and purchase the recommendations that JWB has put in front of me. We're going to help you get to closing, and day one, it's going to produce positive cash flow for you, as well as all of these other profit centers. And so that's really kind of the backbone of our offerings here. And again, it's really, this is an individual property, but you're buying more into a model. You're buying into a model here. And the team, of course, is the thing that really brings this model to life and makes it accessible. And that's what we pride on. It's this client experience that we've done for 18 years to try to refine and perfect it.
Yeah. And again, fully passive, right? Like, you know, I think Greg takes this for granted, but I don't work at JWB. I've also live in Jacksonville, and I've actually never gone to see these properties that I've bought through JWB. Totally passive. I own them. I can fire Greg as a property manager if I wanted to and his team. If I wanted to manage it myself, I could move into it if I wanted to, or I could sell it or whatever I want. But at the end of the day, what you're buying into is the fact that this guy and the 120 of the brightest people that I know here in town just have this thing licked, right? Like they just have it figured out. They have 6,000 properties all in the same area. So I have these like economies of scales for like contractors, pricing, preferential service, and all these different benefits that they've added to all of it in a way that allows me to just like not worry about anything other than the monthly phone call I get talking about how like rents got paid and my home price appreciation is X and all these different kind of things, right? So it's just like it made real estate investing possible for someone like me who is kind of a real estate idiot. But now I am a real estate investor, just like everybody else. That being said, a bunch of questions here. You know, it's hard for me to keep up with the chat, but there's in the Q&A, it's a little bit easier. So I'm gonna try to get to the ones in the chat. I'm gonna hit some of these in the Q&A for sure. The first one is an anonymous attendee says, so holding and not flipping is best in this new environment. Is that what you're saying?
You want to take this, Shively? I think I know your answer.
What? Well, I'll pay you. I'll pay you $5 if you get the answer wrong. Because the answer, as I always say, every single time, is it depends, right? It depends. It depends. It depends. That's like asking a doctor to do brain surgery without seeing a brain scan. Yeah, like it's such a broad question. We still flip here in San Diego, CT Homes. You know, our flipping side of Fortune Builders still actively flips anywhere from 30 to 90 deals a year, right? We got about 28 houses under contract that are currently in process right now that are flips, right? That is an active business, right? That's where we spend our time to make money. What we're talking about is a passive business, buying and holding for cash flow, for growth, for wealth accumulation, for appreciation, for tax benefits. That is a passive business. Any good business needs to have 2 railroad tracks, right? An active track and a passive track, right? You're not going to go very far with 1 railroad track. If you're a train, right? This is not going to happen. You got to have 2 tracks, right? An active track and a passive track. This is what we're talking about is the passive track. Where do you put your money so it's working for you? Flipping, what we've always taught at Fortune Builders is where you're working for money, right? Not wrong, it's just different. Neither one, not wrong. One is not better than the other. It's 2 different strategies, right? Flipping still works. You know, I can march over to JD's office, who actually JD is right there. I don't know if you can see him walking. That's him. That's him. That's JD right there. Oh my God. Right? We still flip every single day. Right? That's what he does in the office every single day. He's in a cast and a boot because he just had ankle surgery, right? But he's still here. He's cranking. So it's a bit hard of a question for me to answer other than it depends, right? It's such a broad thing. Know your goals, know your plan, get on the horn with Gregg's team. Diagnose what you're trying to do and where the holes in your plan are, and then start plugging them, right?
Love it. Agnes Choma is asking, are we going to be able to get financing from JWB? I think that's a good opportunity to bring up this slide, GC.
Perfect. Yeah, absolutely. So within the JWB network, we have an approved lender list. And These are about the best lenders in the business. And I'm glad we can show this slide here because I did want to share with you that recent JWB clients are closing at an interest rate that is lower than 5%.
Let's go.
4.95% is what JWB clients are recently closing at. So yes, absolutely, we can help you with the financing. You'll be working with an approved lender list that we have to make sure that not just are you getting the best rates, but it's the best client experience. And you definitely want to work with a group that has vetted out your lenders if you're going at this for your first time, because the lending world is kind of like the wild, wild west. And many times you can end up doing a whole lot of work to try to get a loan to go through and kind of be left there at the altar at the last second. Doesn't happen when you work with an organization that has vetted out lenders like we do. So happy to make that available for all of you. Again, you can reach out to Tiara, or these are a couple other ways to get in touch with us. You can go to the website here, chatwithjwb.com. You can send an email to info@JWB Of course, you can text Tiara, let her know you want to jump on the phone. But I will, since we have the slide up, I will kind of give the overall highlights of the investment so you can see beyond just that one asset that I shared with you. Minimum investment is going to be somewhere around about $50,000 to $75,000. Estimated rates of return will be somewhere around 10 to 11%. We talked about those interest rates, which again, sub 5% rates now are a possibility. Recent clients have been able to close at those. And then lastly, we do have multiple JWB incentive packages available. We're talking about incentives that will take out between $4,000 to $6,000 of your maintenance costs on your purchases of homes, which we have done recently as interest rates have been so high, as a way to kind of make it easier for our clients to operate in an interest rate environment that was higher than we all wanted. But we're still honoring those incentive packages. We also have incentive packages for multi-purchases as well. And these are a function of when interest rates were higher. We are not going to honor these at some point in the near future as rates come down. So it's something, if you're thinking about investing, this is a wonderful time for many reasons. And you also get an extra bonus from these incentives that we're offering.
Got it. GC, a couple questions about insurance, but just to answer something real quick before that, Lisa Humphreys is asking, what is the percentage of down payment?
25% is what we would estimate. You can go as much as you would like. You can go as low as 20%.
Yeah. So anywhere between 20% to 100%.
Sure.
Yeah. Insurance rates. I think there's been a lot of headlines about like how insurance rates are choking out Florida, like Florida investments. What's your take on insurance rates and how they're affecting these investments?
Well, insurance has made a lot of headlines, especially over the last few years. What happened is there was just a overwhelming number of claims in Florida specifically. And, unfortunately, there were some legal loopholes that allowed people to take advantage of those claims. And it led to an environment where insurance companies were actually leaving the state of Florida. We didn't have as much competition, and insurance costs went up. Mm-hmm. Now, as a rental property investor, that's not something that we want, obviously. But there's two ways to know that you've been protected here as a JWB client. Mm-hmm. Number one, if you bought homes 5 years ago or 10 years ago or any time before these insurance rates went up, guess what? You're winning even though insurance costs went up, because you've had 10, 20, 30, maybe 50% or more home price appreciation. Mm-hmm. And rents have also gone up substantially. So in totality, you're winning if you bought before these rates have gone up, although it's not something that we certainly like to see those insurance costs going up. Now, the good thing is that whenever you buy a JWB property, we're looking at what your your insurance rates are today before we ever share that investment property with you. So like, for example, the one that I just shared, you're going to have today's insurance rate that has just been quoted to make sure that you don't have any insurance surprises. So as we stand here today, they're a little bit higher than what we had in past years. That's already factored into these 10 to 11% returns. And the good news is that the state of Florida stepped in and really closed a lot of these loopholes. Mm-hmm. So we are seeing more insurance providers coming into the state. They are profitable as insurance companies, yep, which is kind of weird to root for, but that's what you want.
Yeah, we got like 9 new insurers in the state.
And they're starting to file for rate decreases as well.
Yep.
So we're not seeing huge decreases yet, but you're starting to see these things that over time, we know we're in a much better spot. And we actually see a potential opportunity for potentially rate decreases coming down the pipe.
Love it. Israel Flores Kook says, how old are your homes? Are they new? I can answer this real quickly. Israel, they have both, right? They have homes that are remodeled homes that are anywhere between 10 to 20 years old.
More than that. I
More-
mean,
or more than that.
Yeah, most neighborhoods in Jacksonville were built in the 50s, 60s,
Yeah.
70s.
Yeah. So some remodeled homes, they have some new construction homes. The beauty of it is that they figured out this like unbelievable business model that's just like an assembly line of homes, so that you're always going to be able to like hit your goals, get to, buy the asset that you're trying to buy, because you guys are wizards at operations. Paul, we got somebody in here that wants to get in contact with you. What's the best way to reach out to you?
I just have them start with Sierra, to be honest,
Okay,
right?
cool.
Help them diagnose their needs, help make sure they get what they want, and they can pass them on to me if they really need, no problem. But yeah, Sierra's where it's at, man. Text that number.
Sounds good. Trying to see. I feel like there's been do you sell land too? No, JWB does not sell land. Annette, you actually asked. You said you have a buyer that's looking for single family homes from 100,000 to 600,000, not rural, with minor repairs. Can you help? I think the answer is that's exactly in the price point, right? Like the homes that you guys saw, like 280, like 220 to 280, no repairs needed. And definitely not rural. They're like right around the urban center of downtown Jacksonville, which is a booming area for workforce housing.
Absolutely. And if you're a real estate agent, we would love to partner with you and to share some commissions with you. So anybody that has a friend or a family member or a client that you think this would be good for, reach out to Tiara as well, and we'll make sure that we share how that referral program works.
Yep. All right. So any more? Somebody asked about, here we go. How does the JWB IRR compare with other passive income deals such as syndicated commercial investments?
Oh man, that's a good one. I would love to talk about different asset classes and how the rates of return compare. That starts to get kind of close to being a financial advisor if you're comparing this asset class and this asset class and this asset class. So I'm going to shy away about kind of doing a pros and cons and even going into the rates of return. All I'll tell you is between single family rental properties, a 10 to 11% return on investment over time is really kind of what you're looking for. What you'll mainly find is that the most respected turnkey providers are actually determining their rate of return based on what's called an internal rate of return, which takes into account the amount of time that it takes to receive this money. Sometimes what you'll see are super inflated returns out there, which don't take into account kind of the time that it takes for these returns to actually happen. So just be on the lookout for things where you see like 20% returns or 30% returns, especially in single family rental properties, because we do shows often where I look at those evaluations and I diagnose where there's a little bit of fluff. And you never want to go into an investment like that.
Okay. All right. Great average purchase price for each of the investment properties. I'm sure the 50 to 75K you suggest for participation does not cover total cost of each property.
The 50 to 75%, 50 grand to 75 grand is your down payment closing costs and your total initial investment. That would be assuming you're borrowing 75% and putting 25% down.
Yeah. So general price range is 225 to 280, right?
180 to 280, but yeah.
I was way off.
Close.
Okay. So that's it. And it's not participation. You're owning this thing, right? You have full control, right? Like that is the big difference. All right. We're a little bit over on time. I thought this was great. Do not forget, text Tiara, get this information. Like you can look it over again all you want. She's a real person, right? So if you're looking at other deals or anything like that, send them to us. We'd love to help you out with that stuff. And 904-293-0341. Paul, my friend, you, as always, you live up to your Hall of Famer moniker, not just in your style, because it's clearly official now that you got that jacket, but because every time you come here, you leave me thinking about a new term, thinking about a new concept. Today was return on equity, man. So I really appreciate how you bring the Fortune Builders community, we do this every Tuesday, right? Like we have this show called the Not Your Average Investor Show, where Greg and I break down the latest news in real estate, concepts for rental property investors, inside tips and tricks from experts in the Jacksonville market and the rest of the United States and all that stuff. So we really appreciate that you took an hour of your day. Denny Davis, who's out there, man, I just want to show you that I got that coin that you gave me, buddy. Thank you for your service. I appreciate you being out there, and I hope you keep our boys safe over there. Anything else from you, GC?
It's always a pleasure to be here with Shively, to be here with the Fortune Builders community, to be here with you, brother. I just love talking shop. And I hope that you all got some value out of this and will be able to use this information to make yourselves and your financial outcomes that much better.
All right. So we have a closing little bit of advice for those of you that join our show. And that is from here until next time we see you, don't be average. See you later, Paul.
See you.